Good morning, Bitcoiners. Hello, and welcome back to your economic calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledin, and as with every Monday morning, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Monday, September the 20th, and we have a full episode and an active morning already in the markets today. In today's issue, we're going to start by looking at Bitcoin options expiration week. We have a large amount of contracts expiring on Friday, and we're going to take a look at how that could impact Bitcoin throughout the week. Second, we're going to take a look at Coinbase's bond offering from last week, which gave us some really interesting insights on institutional investor appetite in this space. Last, but certainly not least, we have a FOMC meeting this week. So it's Fed time once again, and the investors are going to be looking at intently to see if we can get some updates on these tapering plans and next steps from the Fed. So grab your coffees. It's going to be a great one. Starting as we usually do with Bitcoin, we see that Bitcoin finished last week higher by 2.63% at $47,245 to close last night, Sunday evening. From a relative perspective, from a relative strength perspective, we see that Bitcoin was actually one of the few assets that finished in the green. As we'll cover in this issue, most equity indexes, along with gold, Ethereum, and the DeFi index, all finished last week lower. We are seeing some big move down for Bitcoin and most markets this morning. We'll get into that in a second. From a technical perspective, you can see here that the ranges that we outlined from a few weeks back are still, in essence, at play. We see that there is some support that we highlighted, some resistance, that we highlighted here at 48.8. We see that we actually hit and rejected that number last week. And again, we see that this 46,000 level did act as support. We broke that support to the south side this morning. And we also wanted to highlight the support and resistance levels that are further away. Actually, this morning, we already touched the lower support that sits at 43K. And the higher or the upper bound on the resistance is sitting at around the $51,000 range. Again, we see that this line on the bottom, this 43K, did get tested this morning. And it seems to be holding for the time being. So again, key levels to watch is the $43,000 level and the $51,000 level as a lower and upper bounds, respectively. Also this week, as we highlighted in the headline, there are option contracts representing over 71,500 Bitcoins that are expiring on Friday. And there are a couple of factors to keep in mind here. What you have on your screen is options data from Skew. And there are a couple of factors that make this expiration week rather interesting. As you can see from the chart here, there's now actually 73.7 thousand Bitcoin worth of options contract. As of last night, this number was sitting at 71,500. So again, continued build up on the options side as of this morning, given the price move. And as you can see, also there's a very significant buildup in September. It's the largest buildup in the year so far. And this is partially because it's also a quarterly options expiration. Quarterly options tend to be the most liquid because they are the most common amongst option platforms. So there tends to be these big buildups, as you can see in September, and then December is the next sort of quarterly expiration. So you see the big buildups there on the quarterly front. Another interesting insight that we can draw from the options volatility market is the recent disconnect between implied and realized volatility. So that's the graph you have here to your right. And the blue line the graph that's under blue is what's called implied volatility. And the line that's under red, it's what's called realized volatility. Now, while this sounds fancy or complex, you can think of implied volatility as how much the options market thinks Bitcoin is going to move. That's the blue line. And the realized volatility is how much the price actually moves, which is the red line. The current divergence between the two is very noticeable. And if we look at historical patterns, we see that realized volatility tends to converge with implied volatility. In other words, implied volatility can sometimes act as a leading indicator of realized volatility. So according to the above graph, the option markets seem to be expecting a big move in Bitcoin soon. And this was written last night. As we can see, there is a very big move happening in Bitcoin this morning already. So interesting there. Now, another insightful piece, and again, this plays into the price action we're seeing this morning, is that there is a large concentration of open call contracts over the $50,000 strike price, which means that market makers are going to try their best to keep Bitcoin prices under that level until end of day Friday. So that, again, seems to be consistent with the price action we're seeing this morning. However, because there's so many contracts above the 50K level, if price were to rise above that 50K level before Friday, it could catapult higher, as market makers would then be forced to hedge their risks by buying more Bitcoin on the spot market, which therefore squeezes the price higher. Again, given the price action that we're seeing this morning, that short squeeze above 50K seems to be unlikely for this week. But again, important to keep a level on that 50K pain point, which means that market makers are likely going to be trying to keep Bitcoin down below those levels until end of day Friday. Moving on from the options market, another insightful event from last week was Coinbase's bond sale. And the interesting thing here was, or the few actually, the company's original bond offering was planned for $1.5 billion. After receiving offers for over $7 billion in demand, the Coinbase was able to increase its bond offering by 25% to a total of $2 billion worth of bonds. There are two different bond offerings. One matures in 2028 and the other one matures in 2031 with interest rates of 3.25% and 3.65% respectively. So 2028 bond at 3.25%, 2031 bond at 3.65%. Another interesting thing here is that Standard & Poor's rates Coinbase's bonds as junk, yet they were more than 4 times oversubscribed, which means that institutions, or signals that institutions are fighting to get a piece of Coinbase debt. Other publicly traded companies will certainly take notice. Moving over to the S&P 500, last week we saw a continuation of the risk-off trend with all major indexes finishing lower and the US dollar index rising. The S&P last week finished its second consecutive week of losses, finishing down last week 1.15% at 4,418 points. The Dow Jones and the NASDAQ gave back basically 7 basis points on the Dow Jones and 67 basis points down on the NASDAQ, 69 basis points down on the NASDAQ respectively. As we can see here, they're all moving significantly lower this morning. And we're seeing, again, even a continuation from the move that we saw 2 weeks ago. In the Evergrande story, the China Evergrande story that we highlighted here a few weeks ago continues to grab headlines as the market and the Chinese government brace for a potential default. Here are some of the headlines that circulated last week around this topic. Now, as we mentioned, just going back to the charts here so we can see the dollar index. As we mentioned, the dollar index rose quite significantly last week, finishing up 65 base points. We're already seeing it run higher again, or creep higher again this morning. And looking at the China index that we highlighted last week, we saw that last week it gave back 4.15%. This morning, it's already given back up to almost 3% and teetering on the all-time lows for 2020. Evergrande is scheduled to make interest payments this week, and it will likely not be able to do so. And the market could continue reacting negatively, as we are seeing some glimpses of that this morning. Now, outside of China, and going back here to the S&P 500 chart, outside of China, the big market event this week will be the FOMC meeting, and that's the Federal Open Market Committee meeting that is being held by the Federal Reserve. That happens Tuesday and Wednesday. And Jerome Powell will be giving a press conference on Wednesday, and it will be very interesting to see if they reference any potential risks of financial contagion coming from China. To highlight how this contagion could be, is spreading through some markets, let's take a look at some examples. When the China real estate or the Chinese real estate market suffers, the entire supply chain of that market suffers with it. Builders need a lot of raw materials by way of commodities to build these projects. And Australian mining companies are large suppliers to the Chinese real estate market. Rio Tinto is an Australian-based mining company. Let's take a look at Rio Tinto's shares. If we look at Rio Tinto, we see that it has been coming down quite a bit. We see that it's actually given back around 26% over the last 6 weeks. And the velocity of the drop seems to be accelerating, with the stock given back pretty much 10% in the last 2 weeks. If we just draw a line here, actually 13% in the last 2 weeks. So again, the speed of this drop seems to be accelerating given what we're seeing in the charts and as the news continue to flow out of China. Elsewhere in the Chinese markets, we're seeing bond values for other Chinese real estate developers come down aggressively. And that's the example you have in the back of your screen is the bond for Fantasia Holdings Group, which is another well-known Chinese real estate developer. The precipitous drop in bond prices is causing a liquidity crisis in China and has forced the central bank to pump $14 billion into its reverse repo market. And that's the headline that you have on your screen right now from Al Jazeera from last week. To explain why banks or why central banks would do this, they are in essence lending cash to their retail or commercial banks, taking select securities as collateral. Typically, these securities are treasury bonds. This prevents banks from having to go out and liquidate those treasury bonds to replenish their cash reserves. Selling bonds drives the prices of bonds down and yields higher. And this is the first sign that China is trying to prevent the contagion of its real estate bonds to hit basically its banks and other parts of its financial system. So far, it seems that the contagion has been contained, for lack of a better word, to the real estate companies and some mining companies. Basically, the Chinese government is signaling that it's going to do whatever it can to shore up that contagion from hitting other parts of its system. Developments from both the Fed and Evergrande will continue to keep investors on their toes and will continue to update you with any relevant information. Moving over to our analysis of gold, while gold typically does well in times of financial uncertainty, the recent slowdown in the pace of inflation and the fears of financial troubles in China seem to have pushed investors to seek shelter in the US dollar and certain US Treasury bonds over gold. As we can see here, gold finished last week down 1.91% at $1,753 per ounce. Now, as we've highlighted, gold tends to suffer as the real returns of bonds, or gold has a negative correlation with the real returns of US Treasury bonds. So as we see, when inflation has been coming down and bond yields have been creeping higher, this is unfavorable for gold. And to highlight some of what's been happening, the highlight or the headline that you have on your screen was essentially from the CPI read in the month of August that came out last week in the United States. And in that read, we saw that essentially the consumer price index in the United States posted a smaller than expected increase in August relative to July. So there seems to be that the speed of inflation seems to be creeping down. And as we mentioned in the earlier section, the dollar index did really well last week, rising 65 base points. And so did the yield on the 10-year curve. Both of those went up considerably last week, as well as we saw a lower than expected drop or lower than expected rise in inflation. So again, putting those pieces together, gold is inversely correlated to the real return of US Treasury bonds. The real return of US Treasury bonds is simply the yield on that bond minus the inflation that is expected. So as we see, the yields moved higher this week, inflation moved lower, the real returns of bonds moved higher, and therefore it put pressure, downward pressure on gold. So going back to the chart, the big catalyst for bond yields and that which could impact gold will be the FOMC meeting this week. So again, lots of moving pieces with both big news coming from potentially the Fed and China this week. So interesting, as they could both impact gold, the gold market. So we'll stay attuned to those and share any relevant updates. Moving over to our analysis of the DeFi space, it was a roller coaster week last week in the DeFi space, with the index closing down 2.25% lower for its second consecutive down week. Ethereum also closed the week down 2.27% at 3,328. We see that both of these are moving down significantly lower this morning. On a relative strength basis, we're seeing Bitcoin seems to be dropping less than Ethereum in the DeFi index, and last week it rose higher or more than Ethereum in the DeFi index. So interesting tidbits there. There were several events during last week that were quite relevant for this space. A meaningful one in terms of mainstream media awareness was the fact that The Economist chose to dedicate its most recent cover to DeFi. And as you see the image on your screen, the cover page that The Economist gave to the DeFi basically talks about going down the rabbit hole, highlighting the promise and perils of decentralized finance. The article is interesting in that it examines the potential benefits and risks of DeFi and presents the space as a potentially promising area within the crypto landscape. This is somewhat unusual for mainstream media and seems to be a change for the better, just relatively more informed reporting. Another news that impacted markets in the DeFi and Ethereum world was the fact that OpenSea, the largest NFT trading platform, admitted that one of its employees had been trading with insider information. This is a big blow to the NFT community and something that may have more enduring consequences for OpenSea. It is one of the first large-scale scandals within the NFT community, and it will be interesting to see how the market and the community react given this event. Lastly, around this front, Solana, which had been rising for 8 consecutive weeks, let's just open up the chart here, had its first week of losses last week, finishing down 12.29% as it suffered a significant outage last week. And that was reported by Bloomberg and others. The network was down for 17 hours on Tuesday as it was flooded by transactions and suffered the outage due to an issue called resource exhaustion. So again, lots of moving pieces on the Ethereum and the DeFi space, particularly with some of that mainstream media attention and that very interesting cover by The Economist. So we'll continue to monitor things here and update you with any relevant information. Moving over to our Bitcoin mining difficulty commentary, the next difficulty adjustment should become effective sometime this evening, Eastern Standard Time, and it's projected to bring difficulty higher by 3.3% to approximately 18.99 terahashes or 19 terahashes. Checking in on the mempool, which you have behind your screen, transacting on the network or on-chain remains very cheap and very fast, with next block confirmations hovering around sub 10 satoshis per byte. Elsewhere in the mining space, the crackdown against Chinese miners or miners in China has not lost its intensity, with the government now targeting miners that are disguised as data researchers or secretly mining Bitcoin. The headline came out that basically China's Inner Mongolia had hired a contractor for the purposes of this hunt. Perhaps the Chinese government was opportune to let its miners know that they are still very much after them, regardless of anything else that might be happening in the country. Any miners at scale left in China would be foolish not to try to reestablish their operations elsewhere. And as always, we wrap up with what's ahead for the week. Fall starts this week, and it already looks promising for Bitcoin ETFs. There has been a lot of action on this front recently, with evidence of a potential approval sometime between October 18th and November 1st. The approval calendar that I'm going to share right now, that's the one you have on your screen, is courtesy of Eric Balchunas, ETF analyst at Bloomberg. As we have mentioned in recent issues, the SEC has signaled that it will likely be approving a futures-based Bitcoin ETF before a physically held Bitcoin ETF. The first such application, the futures-based ETF application, up for approval is Valkyre's. That's due for a decision on October 18th. We could be celebrating more than the 14-year anniversary of the white paper next month, so interesting to mark your calendars. Beyond Valkyre, other ETF applicants, like Fidelity, are trying to make every effort to try and get their applications approved as well. And behind your screen, you have a headline from Fidelity last week, which in essence mentions that Fidelity is presenting and trying to lobby the SEC to process and approve its application. Now, with the GBTC premium still trading at around a 15% discount to the net asset value of the fund, investors seem to think that this fund is unlikely to become an ETF anytime soon. So interesting insights here, and we'll keep our eyes out for these very potentially exciting Bitcoin ETF approval. As always, we're going to wrap up with a summary of upcoming economic data and potentially important earning reports for the week. So this week is a bit quiet today and tomorrow, and the big economic data starts coming out on Wednesday. So Wednesday, 8:30 a.m. Eastern, we get existing home sales in the United States for the month of August. Expectation here is for 5.99 million units, or 5.99 million homes. However, investors will be more interested here in the pace of price appreciation in U.S. real estate. The median existing home sale price for last August rose 17.8% on a year-over-year basis. So houses sold in August were almost 18% more expensive than houses sold in August last year. The market will likely cheer a slower year-over-year number in growth for September and will likely sell off if the year-over-year appreciation in the month of September is higher. At 2 p.m. on Wednesday, we get the Federal Open Market Committee meeting statement. And at 2:30 p.m. on Wednesday, we get Jerome Powell's press conference. Powell's press conference on Wednesday will likely be the main event of the week. Investors will likely get to hear more details on the Fed's tapering plans. And a big surprise would be if the Fed were to say that it already has started tapering. This would explain some of the recent divergence that we're seeing in the price action between the 10-year bond and the 30-year Treasury bond. It will also be interesting to see if Powell makes any reference to potential headwinds from Chinese markets. Thursday is a bit quiet, but Friday again, we have some interesting data. 8:30 a.m. Eastern, we get new home sales out of the United States. The expectation here is for 708,000 new homes. And the number of net new homes will be interesting here, as it will put the Fed's $40 billion a month purchase program of mortgage-backed securities in context yet again. For reference, the Fed's $40 billion a month purchase represents about 25% of all net new mortgages for all new homes sold in the United States on a monthly basis. So pretty meaningful, pretty interesting. We will also get to hear from the Fed on how it intends to taper this program on the mortgage-backed security side. The tapering should put upward pressure on U.S. mortgage rates, which could have a cooling effect on the real estate market. So that wraps up our show for today. It's a big week coming up as always, and we'll keep you posted with any relevant news and information right here through the economic calendar and in our social media accounts at Hodl with Ledin. You can follow me personally at Cryptonomista. Thank you, everybody. If you enjoyed the show, if you learned something, if you like it, I welcome you to thumbs up it down below, subscribe to our channel, and share it with your friends. If you don't yet have a Ledin account, I welcome you to check out ledin.io and learn how you can start earning up to 6.1% on your Bitcoin and up to 9% on your USDC. We also have the best rates on Bitcoin-backed loans if you need cash but don't want to sell your stack. Thank you, everybody. Have a wonderful week and see you next time.